How's everybody? That was so effective. I didn't think I'd be able to be so effective. Cool, let's get started. Let me figure out where my clicker is. That would be step one. Yeah, thanks for coming all the way down to this hallway. I was here 3 years ago as an MBA, and they didn't even have this building. So it's very interesting, exciting to be part of it.
Welcome back.
Welcome back. Thank you. It's yeah, first time in 3 years. I'm really excited. Cool, and I'm not getting any feedback, so I'm just going to turn around a lot, and you'll get to see the back. It's okay. And I'm also going to try to keep it to 45 minutes, maybe 50 minutes, so we can talk about stuff after. And we can talk about the session. We can also talk about anything on this list, and probably as many things not on this list. From MBA to Silicon Valley, how venture investing is changing, AngelList, what it's like to be employee 2, de-MBA-ifying myself, how to communicate traction to investors, the 5 companies I'd leave Greylock for, how reference points have changed my life, how seed fundraising actually works. Scratch that, we're going to talk about that for an hour. Strong opinions on accelerators, the pace, and we have a good one here, so I have to be careful what I say. The pace of true creators, the magic of rapid prototyping, which I did during the MBA in one of the classes to fake a digital product, which is really interesting. Learned a lot in 3 hours. Data in VC, which is what I do now. The most interesting companies I saw at AngelList, which is a long time ago now, so I probably forgot most of them. The strategy to building a great early network, which is very important. Who actually changes an industry from within, why it's an amazing time to start a tech company. Productive life is a series of rounds in a game. That's a career thing I feel strongly about. Focus, low ego, and other life experiments. That's a personal thing lately. How I got my job at AngelList and Greylock. What's in a great fundraising pitch is the next session right after this in the same room. How to find a great job in Silicon Valley. And Silicon Valley is more than Google and Square, which is specifically targeted at this group because everybody comes and says, we want to work for Oracle and Google and Square. And there's like 300 other amazing companies that are cool. But this is my background here. The stuff that doesn't matter as much for this, I worked in low-cost tech in sub-Saharan Africa for a couple years. I'm a recovering materials engineer. That's what drew me to Oxford because not only did I like the social entrepreneurship thing, I thought it was important, but I wanted to be surrounded by other people who had these sort of broad views, and that was 100% the case with my group. I went to the spin-off institution for a master's, came here to the MBA 09-10. None of that is really relevant. What we're going to talk about today comes from about this phase of the last 3 years. I joined AngelList as my internship right out of the MBA program and managed the deal flow there for about 8 of the first 9,000 pitches as we went from a website that was very literally a WordPress site with a Wufoo form and Gmail to send out introductions to much more of a fully fledged platform and product that it is today. And they kind of built that around me. I was the dumb guy who could just manage the deal flow, and then we hired a lot of smart engineers and designers and went from there. I did some research, which we're going to talk about today. I did that simultaneously with AngelList. As part of the MBA, you could do, when I was here, you could do a 15-month program, and the last 3 months was a dissertation. So it was a little more conventional research, and so that's what I did. It turned out to work out very well. I don't think it would work well in a lot of cases. And then I joined Greylock after that. We're not going to talk that much about Greylock, but my role there is not on the investing side. I work very closely with them and have worked on some of the investments that we've done, like Tumblr and Instagram, just because I like that stuff. But mostly I'm trying to, my team tries to think through how venture is changing, what it's going to look like in 10 or 20 years, how Greylock can kick ass, remain a great venture firm in 10 or 20 years, how we can build scale, how we can build products, how we can use data, how we can use system internally, and hopefully externally as well. So that's what we do at Greylock. But I want to go back to right after, this is like a fraction of it. I want to go back to right after the MBA when I joined AngelList. It was the first time I'd been to the Valley. First time I'd worked, lived in Silicon Valley, been surrounded by these people. And still, I felt that I had jumped into the middle of something that was interesting and that was changing quickly. And even without the historical context, it felt like the world was changing around us. And what that meant in my inbox is that this is actually reasonably early in my time at AngelList. This is a fraction of a day's worth of pitches I saw. By the time I left, it was sort of like screening 50 to 100 pitches a day and trying to send out, the best couple to a few thousand investors. But what we had done, we managed to get some excitement on the investor side, but we really tapped into a need on the startup side and got flooded with interest, right? So we had touched on a gap. This is what I saw day in, day out. What I saw when I looked around was that there was all these symptoms popping up of change, right? And some of these look disconnected, right? Some of them, some of them are early stage. Y Combinator, Techstars certainly had been around for a few years, but maybe in the year previous to when I joined, or the year and a half previous, they'd really start to see some of the big wins come out. And not only that, but you started to see like a flood of new accelerators coming in from every possible angle. AngelList, there was something we were doing that worked, right? That was working, right? It was messy, the path wasn't necessarily clear, but it's working. And recent, even at the later stage, you had VC firms coming in with new models, new philosophies, new brands. You had local markets and centers like TechCrunch Disrupt, or you could call it the launch conference that Jason Calacanis ran, which are essentially like localized markets, and those were legitimately spinning out good companies that got funded, and actually some of them turned out to do very, very well. And I put 500 startups up here because it's an obvious one, both in the fact that it tended to be going a little bit more global, which was happening, and I think has happened a little bit slower, but there was a blast of institutional capital coming into the early stage, right? So angels were institutionalizing, raising money, and becoming seed funds, right? And this is not the first time this has happened, of course, but the rate at which it was happened seemed to be extreme. And this is fueled on the other side by pretty deep shifts in the way in how companies were created, and how products were created, and how products reached people, okay? So if it's anything from Heroku-style new tools to make it much easier to set up and start and run a company, to the different pieces that if you're building a tech company, you can plug in. So Twilio is, if you want to integrate SMS into your product, it makes it very easy. There's an API, you can just write that and build that into your product. Twilio is a great example, a huge success story, but this is happening at so many different layers in tech right now. It means that you don't have to master all these layers if you're starting a company. You can just focus on what you're good at and plug in the rest most of the time. And on the consumer side, let me just caveat and stop right now. I'm talking mostly about consumer stage internet investing software, right? AWS, again, makes it very easy, like much easier than before to start a company, to spin up a company and product. And then how they grow, right? I mean, Twitter is one platform that many people have used. Many companies have used. Facebook is another. I think actually much more fundamental is iOS and Android becoming platforms that you can scale very quickly from, not only in sort of reaching into an address book and understanding the context of people's lives, but the fact that we pull this phone out probably 150 times a day. On average, it's something like between 100 and 150 times a day. We're conditioned to use it for a few minutes at a time. It's much easier for responsiveness and to build habits with this device versus what we used to have when we went and sat down at a desk, for 10, 15 times a day. So the frequency with which things are spreading is changing very quickly. So that was happening. And then what we saw with companies happening, and this is an example. I took Pinterest. Everybody know Pinterest? Amazing company, huge success story. And what I've done here is map the estimated and reported valuations of their rounds. So this is not inside knowledge. This is what I would have guessed or what was reported in the press over the time frame. And they're now up to sort of being valued in the multi-billion-dollar range. The result of all those shifts on the previous slide look like this. Not that you have every company doing this, but you have many more than before, and they're doing this much quicker than they ever were able to before. And if you map, we did this internally, but if you map sort of how long LinkedIn took to get to X users, and how long Facebook took, and how long Twitter took, and how long Instagram took, those curves, come on in. Those curves look steeper and steeper, right? And this actually Pinterest matched so well with what I was doing when they were seed. I was at AngelList, and by the time they got to their second venture round, I was at Greylock, and joined for that. Today we're really going to talk about this part. We're going to talk about this part for a couple reasons, but mostly because that's where I think the disruption and innovation is coming from in VC. Any classic sort of innovator's dilemma style disruption usually comes from the bottom and it looks trivial, which is the early stage. It also is the place where the N is so much greater, the sample size of funds, of companies, of investments. Not only every round has an average of many more investors than later stage rounds, but there's many, many more companies being funded at the $500,000, $1 million level than there is at the $50 million level. So that's where the experimentation is happening. What I didn't see was anybody figuring this out. Okay? So the reality, and I have a strong bias view, but what I think I saw at the time, with all these things happening around and nobody explaining it sufficiently, especially coming out of this place, and you're sort of expecting there to be some knowledge on what's happening. On the right, this is sort of this is an analysis that was part of the sort of baseline for my research, but it's all sort of network analysis, high-level network analysis of entrepreneurs and whether network centrality allows them to be more successful, right? And the conclusion is yes, right? The conclusion with a lot of network stuff, which Mark will talk about next term, is that the more central you are, the better a position you're in, and the better you'll do on average. And I like this conclusion. I kind of buried it under the title, but I think it was something of this purpose, is that the central purpose of an entrepreneur is to build a strong, centralized network, right? Most founders will tell you that's bullshit. The central purpose of their job is to get people to use and pay for their product day after day. The central purpose of their job is to make payroll and hire, the next great developer or salesperson. So this is a level more abstract than any founders than is useful for any founders. And the other analysis was also very high level, tend to be very economic, relying on as perfect data sets as we could find. It's sort of like $26 billion was invested in venture capital in the last year, and that's down 3%. And payments as a sector has increased 5%. And how is a founder going to use that, right? How is that? I mean, even as investors, we don't really care about most of that stuff. Like, we're kind of down a level of specificity. On the other side is a sea, an ocean of blog posts, of advice. I'm picking on Mark Suster here, which is unfair because I think actually a lot of this advice is useful, and I think he's one of the 5, 10, 15 people who have really contributed to a bunch of knowledge that's really helpful to people, right? But usually this stuff is not very rigorous. It's not based on anything really quantified. We call it sort of pattern matching. We've seen trends as investors on the investor side, or as founders, they have sort of like first-person experience. When I built a sales team in 1995, this is what went wrong and this is what went right. And I think that's a great starting point, but it's 2013. It's not 2005. It's not 1995. So I was dissatisfied with these two options. And I wanted to figure out what's going on. So like the founders around me, I started where I was. And AngelList worked in a co-working space, and we shared a wall with these guys. They were called AppMaker at the time. They were building a product that lets anybody build an app with very low, seems obvious, right? AppMaker, make an app with very low technical skill, if any, actually. And I should mention, guided by Mark Ventresca, as well as my supervisor, who was incredibly helpful at grounding me in what actually was concrete theory and pulling me back and saying, okay, you're talking about this, but what you're really talking about is this phenomena here, which is sort of like market evolution, blah, blah, blah. You should take his class next semester. The single most interesting class I took at Oxford was in his course, and it was on networks and how they form and how the position in your network or between networks is one of great opportunity, but fascinating class. The other reason I want to put this slide up is because I think you should move to San Francisco if you're not an asshole. So for any non-assholes, cool people, please move to the Bay Area afterwards. We have probably 20, 30 people there now from the last 3, 4 years. A really, really strong group of people like building things, making things. Some work for big name companies. Some are working on their own thing. Renting houses on weekends and going surfing. It doesn't get much better than that, right? And it's an amazing place. But Daniel here in the center is a friend, and we shared a wall, and he's also a great supporter of the entrepreneurial ecosystem there. And so what I did, and they had just raised a $1 million round from about 14 investors, and it had just finished. And so somehow I convinced Daniel to let me dig into that as a case study. And I also somehow managed to convince him just to hand over the keys to his email. And so I dived for a couple weeks. I dived into his email. We found all the emails pertaining to his raise period, right? So like introduction by email, scheduling meetings, blah, blah, blah. And then I worked with that. That was my sample set. It was just 500 plus emails or so. And I think this, well, I'll tangent a little bit. I don't think this could have happened until recently. I mean, I think if you tried this 10, 15 years ago, it would be much harder to map the path that somebody took through networks of other people to achieve anything because the records of those were just not there, right? But now I have some confidence, not 100% confidence, but some confidence that you can do this with email. Even if you're meeting in real life, which was the majority of his interactions, email is scheduling it, email is the initial introduction, email is a follow-up. Hey, great to meet you at Silicon Valley comes to Oxford, let's reconnect when you're in the Bay Area, right? So I think probably, and I don't know this, but I think probably like 95% plus of his actual interactions were recorded in some way by email. And it was also a great memory trigger. You say like, okay, tell me about this one. When did you actually meet this person? That I just have sort of like a scrap of information in email. And then so we would rebuild that. So I did that and took a couple weeks to do that. And then took a couple weeks moving pixels around to figure out what happened. And it looked like this. So this is a seed round. We're going to talk about it in a little bit. We'll dive into what's what and what it means, but the basics, it goes from June, July, August, September, October, November along the top. This is a timeline. The y-axis does not matter. I tried using a y-axis, but it made it impossible to visualize. And I'll talk about it a little bit more, but each one of these bars, each one of these lines is an interaction with one actor. Okay? So he met this one person, and then they talked about them giving him money and he giving them equity. Yeah, let's talk about it. So the key actors, so this is what it looks like, a section of it looks like closer on, right? A little easier to see there. Key actors, let's start at the bottom. VCs, they're the dark ones. They look black. One of the basics of information communication and visualization is that if it were black and white, it would still work out, and I totally failed at that. So if I redid this, I would be better at the InfoViz stuff. But the dark ones, this one, these four here are venture capital firms. So that would be, call it like $200 million plus. All of these are anonymized, but it would be firms like NEA, Sequoia, Kleiner, Excel, Greylock, IVP, General Catalyst, stuff like that. The brighter green ones are individual angels, right? So they're not institutionalized, they're investing their own money. Many, many more of them than VC firms. And the white ones, which are harder to see until you hit a bubble, are the seed funds. So this is like I think most of them were relatively new generation, like 500 Startups or Felicis or First Round Capital or SV Angel, et cetera, in the Valley, right? What you also had was some red dots, which I called institutional actors. In this case, this is AngelList, this red dot. But it was also sort of, if you went to TechCrunch Disrupt and you got a bunch of introductions there, I would count that as a red dot. I also looked at angel groups, which were insignificant in his round, and a few other things. Oh, the other one that's worth mentioning is there's a yellow dot, which is a middleman, like a connector, so that's somebody who could not provide cash but did. And then every gray line is an introduction, right? So what this means is that AngelList here made these, in this case, I think it was like 25 introductions in the first set. It would go to an angel, and then every X is a rejection. So if we can just take a second and internalize how many rejections this guy had when he was trying to raise his money, that's what raising money is all about if you're not a superstar. So yeah, X. And then whenever there was a big bubble, that's success, right? So it was $150,000 here, $100,000 there, 75, 150, right? So if you back out, this is what it looks like. We're going to dive in to some of them in a sec. But some of the basics, he spoke with about 173 people over 5 months, which is a lot. It was pretty nicely split between VCs, angels, and seed funds. These, among my network, are decreasing or have long since decreased in importance in Silicon Valley. These are very important, but they're not large in number. This is a debate These people are where the highest potential is, I think. We'll talk about that a little bit, especially in the next session that I'm doing, which is more practical. And then that's your targets. I think people overvalue the VCs. People at the early stage go to VCs much too quickly because they're obvious and we're obvious and easy to find, and we have the reputations, and you know where we live on Sand Hill and stuff like that. 10% hit rate, which is really good to show founders who are not superstars. And Daniel, by the way, super credible founder, but he was moving from Washington, D.C. to San Francisco, so this is his sort of like initial foray into the network too, right? So credible, fundable guy, but he's not a superstar who has, 10 high net worth friends that can just raise it on a weekend, right? This is actually, most of the people in my sphere are this, right? So if he got 10%, what he needs to know and what most founders need to know, and at accelerators we talk about this, if you're converting 10%, you're actually doing great, right? For various reasons. Because probably 70% of your targets are not predisposed to invest in you anyways. They invest in this thing, and you're actually doing that thing, and they took the meeting because somebody referred them, and they don't want to insult them. But 10% is pretty solid. I would say like 15% is good. If you're converting 20%, you're doing something totally right. So part of this whole analysis, not only in saying that you had to hit that many people, but the conversion rate is going to be that low, is to say like, when you're doing this, it feels, I don't know, I'm not a founder, so I don't know, but it must feel, 2 seconds. It must feel shitty. It must feel like you're doing something wrong. But if you get, 15%, you're doing something pretty good. Yeah.
But it also depends on the amount of money that you get. I mean, I could get 100% commitment rate if I asked 10 euros for each of my project, and I would be a superstar in that case.
Yeah, and then your N would have to be 1,300 instead of 130, I guess.
But my rate would be through the roof.
Maybe. I mean, that's possible. Practically, I don't see it. We'll see if that happens with crowdfunding, and that's a whole different situation that has emerged since. So I don't think you're wrong at all. I think you might be right. But the caveat I would say is that I don't think decision-making happens based solely on financial terms with most investors, or for financial reasons. I mean, obviously they're trying to make money, but I think it's much more, do I want to make this time commitment? Do I want to spend the time and the effort to value this properly? With VCs at the later stage, it's much more explicit. My partners have 10 board seats. That's basically it. So it's not that, we do care about the money and we are price sensitive, but it's much more, if I get N investments in the next year, 2, 3, is this going to be one of the ones that I'm really happy with and that I'm willing to spend, at the beginning, half day, a day, 2 days a week with, really helping out. So it's not always, I would say, often it's not always financial.
So you said that you used degree centrality to measure the success of entrepreneurs.
I did not, but.
Okay, but wouldn't it make sense to use eigenvector centrality here to see that VCs might be more influential in the network, and then you use that to predict success and conversion rate?
Mm-hmm. Yeah.
You did that?
No. If you can find me a data set that's accessible for a founder to use and understandable to plug in a day where he could take that and where he could trust that information, or she, by the way, sorry, I'm using Daniel as an example, then that's awesome. You should add that to the mix. For this, I am not out of that field. I'm not an academic. And so I think there's a whole set of much higher level, more rigorous network analysis that is very useful. But also that unfortunately waits for a more perfect data set, which uses often data sets that are not 100% relevant. So what can you see in terms of connections? You can see co-investments, you can see connections on LinkedIn, you can what elements of network can you actually pull down? So that's a question, and in reality, it's sort of like it's whether you met Jim and you're not connected on LinkedIn, but you went to his daughter's wedding or something like that, right? And then the other reason I didn't is because I just wanted this really first-person view from a founder's position on how to walk through. So I think there's a ton of value there. I didn't do it.
I think this is a good Kickstarter for amazing learning. I mean, it's just great learning. You just you do all this. You got to work really hard. It's just like I know people think it's like, if I just meet the right person, it's all going to be cool. And the other thing that occurs to me here is, as you're doing this, you're also growing as an individual. Because every rejection is growing you as a person. It must do. Like
Hopefully.
otherwise, you know, and so there are people who might get funded by their parent or somebody that just funds them straight away. And I think, I have no analysis, but from my own experience, that even if you bet on people who don't have the resistance up front tend to fall out later.
Yeah.
So I think this is very interesting the way you look, and the interesting hypothesis around, you know, the more rejections up front, the better later stage, you know, and you know, it just grows you.
There's something to tenacity that is incredibly important that I would rank as the highest, most important factor for any founder.
Really care about this. I mean, I'm just
Yeah, he was fierce. He was fierce. And he got knocked down too. Like, I mean, he thought he was raising a $10 million round from a top 6 VC. That was his first meeting. And then he learned that no, he wasn't there. He was raising a $1 million round, and he just totally wasted that meeting. We have more as well, so we're gonna pass through a lot of this information. But
on the flip side of those numbers, when you're thinking from a VC perspective, how many rejections versus commitments would you make?
Yeah.
You know, VCs versus angels versus seeds.
yeah.
How should an entrepreneur think about going to those guys with their success rate? You know, kind of getting committed.
Yeah, I think the common answer is about 1%, right? So that's a common funnel. We probably see 5%. I don't know. At Greylock, so later stage, we probably get 10,000 contact points with companies. Each one on our team, we have probably 10 people on our team, are seeing 200 to 500 pitches a year, and each one of those people is making a couple investments, right? And more makes it down the funnel. But the thing that the challenge with any data set in this industry is that the quality level looks like this. Actually, the quality level looks much, much steeper than that. And so, like, where do you stop this analysis? Do you stop at the 5 best companies? Do you stop at the 50 best companies? Do you stop at the 5,000 best companies? And so, mostly, and we're going to talk about this a little in the other section, as you move that way, of course, the odds increase dramatically, right? Which is one of the other, this is one of the big problems about, and challenges with research in this field. The other is that the changes are moving much, much faster than academia. It's like every 6 months, things are changing right now. Let's keep going a little bit. And if you have questions, we're going to see that chart a couple more times. Some other stuff, seed funds, very lucrative for Daniel. An average of $12K per, right? This actually makes sense. There's fewer of them in numbers. They're making more investments. If you look at like SV Angel or 500 Startups portfolio, it's in the hundreds, right? So I was actually surprised how high this was. But VCs kind of write big checks, right? So if you get a couple of them, then it doesn't make as much sense for Greylock to write $25,000 checks. We're happier writing $100,000, $150,000. This is a big thing. If you think, like, so many founders think that they're gonna, they book a flight with a return flight from Silicon Valley in 2 weeks, and they think they're gonna wrap up a round. That's not how it happens, by the way. It's a great place to fundraise, but it takes longer than that, especially when people aren't getting back to you for a month, right? So the turnaround times are very, very long. And this is a fuzzy chart because actually most of the time there was no answer, it just dropped off, right? They just didn't hear anything back. I think one of the most useful things you can do as a fundraising founder is try to get them to know. Don't worry about yes, try to get them to know and get that overhead of all of these relationships, these new relationships you're trying to maintain out of your head, right? So that was the basics. Here's where it actually got really interesting. And here's where it became a lens into how the industry's changing. What I found in hours and hours and hours of moving pixels and lines around is that it actually clustered very nicely into 3 different sort of groups, clusters of behavior, which I call the old style, the new style, and the time wasters. Right? Here's the chart again. Time wasters are on the bottom. It's basically here down. The old style is here, is in the middle. I should have probably given them more space to breathe, but we'll talk about what it looks like and why it's different. And then the top, anchored by this red line all the way through with 3 interaction points, is the new style, which was AngelList in this case, but I think it could be a bunch of different things right now. I don't think it's just AngelList. It could be an accelerator demo day. It could be a conference. It could be another crowdfunding platform. It could be something we haven't seen yet. I am sure we are not finished seeing new models of matching here. So what do they look like? So the old style was driven by an influential person, made a bunch of introductions. And the interesting thing is the weight of those introductions and the influence carried through the network. It was really interesting to see that happen. And this is how fundraising has typically happened, right? This is what the reality, looking backwards, that I kind of walked into, which is I'm fundraising, so I go meet Joe. Joe decides to invest or not. If he decides to invest, he introduces me to like Rick, Mary, and Jane. You know, maybe I get one of them. Then, okay, Jane is interested. So you sort of walk through the network, right? Very much based in personal relationships. Very much based in the question, which is very hard to answer, by the way, like, who should I talk to? You're like, oh, well, you should talk to this person, this person, this person. Here's what it looked like. In this case, this is an angel investor who did not invest, but had a pretty good reason. So usually if you don't invest, you're not going to get a lot of downstream introductions, because every one of them is going to say, well, why didn't Jim invest, right? If he didn't put his money behind you, then I'm not going to. In this case, it was the early stages of convertible notes versus equity. Now convertible notes are very common, but 2.5, 3 years ago, they weren't. And so he said, in a principled way, I only invest in equity, but I think this is great. More introductions. 12 introductions, there's a couple missing here. Actually, these were also no's, so there was like 3 immediate no's, rejections there. A few more scattered rejections. Actually, this first set of introductions worked really well. It took a couple months, but he raised, 100K, 50K. And what happens, even with some of the yeses and nos, is there's further downstream, introduced to this person, introduced to that person, introduced to these, and there's a bunch of bubbles on that side of the chart. Okay? So this is I think this is the way early stage fundraising used to work. And a lot of it still works. The new style is interesting. The behavior is totally different. There's a market intermediary. In public markets, we call that NASDAQ, right? This is not a public market. There's a bunch of different local intermediaries, whether it's like Rock Health, Demo Day, whether it's AngelList, whether it's conferences, whether it's pitches during your course. All these are sort of like localized markets. And I think there's going to be a bunch more of them. But what happened is that it played out much more like an efficient market. And so what you saw, there's a sort of a trusted intermediary. Believe it or not, I was trusted when I was at AngelList. Got a bunch of very efficient introductions that took way less time to match. Very high hit rate, right? The conversion rate was high, lots of money came out of that. And then the interesting thing is none of them led anywhere else, right? So these folks did not turn around and say, oh, I just made a great investment. Let me make sure that my 5 friends have an opportunity to invest as well. So even though they could have, these people have great networks. But what's happening when you're going through that system, I think, is that you're evaluating it much more like an impersonal market. You're deciding whether you're going to buy that good, and that good is a chunk of a startup.
There's an assumption that the
There's many assumptions.
when you no, I'm just quick. I'm just
please.
thinking. There's an assumption if you invest on AngelList that others can see it anyway. Is that why they might not do that, or is it or just yeah?
That's a good question.
Because I would presume like, okay, so I've just joined 2 weeks ago, and I see the stuff that it's kind of transparent, which is good.
Yeah.
You just know who's invested in what.
Yeah, I think that's a good point. AngelList at the time, it definitely didn't have that visibility.
Yeah.
And so you would not have seen it was much more. It wasn't intentionally private, but they just hadn't built out that stuff, or we hadn't built out that stuff. Now I think that's right. They're trying to build a platform that allows reputation and influence to propagate through, and for that to be essentially rewarded. Yeah. And then there's the time wasters, and this is mostly a slide for anybody who's raising money. I think it's really hard when you have an introduction to somebody who could potentially invest in your company to understand that the likelihood of that is really low, and it's not worth spending a lot of time or energy on that person, because everything could be a check. But if you look at it as a system, so many of them aren't, right? And what this was as a system was a whole bunch of completely disconnected 1, 2, and 3 offs that went absolutely nowhere. There was one bubble, but Daniel already knew him. so it doesn't even really count, right? And so what you have is like almost equal numbers in clusters 1, 2, and 3, and the 3 is totally useless and probably combined occupied a month and a half of Daniel's life, chasing down nothing, right? So one useful thing is to move up a level and understand that the likelihood of many of these is very low versus the likelihood of other ones, and to put that energy, that emotional energy, that time, and that effort into the ones that have a higher likelihood, right? And we saw this in different behaviors as well. So AngelList was 3 times more efficient per introduction in terms of the money that they raised versus the other ones. This is the graph that looks the worst, but I think is the most interesting. This is fundraised per degree from the origin. So like the first point of contact he had, and then as he had another downstream introduction, and then downstream introduction, and then downstream introduction, how much money did you raise, right? Blue is AngelList, just because I wanted to switch up the colors and confuse everybody. Blue is AngelList, raised a lot of money right away on the first blast. And then dropped to very low amount of money, about 75K here. And then dropped to 0, 0, 0. Red is the old style, the traditional way of fundraising. Started out less efficient. Again, went to fewer people. You could access fewer people. Next point from the origin, it dropped down. And then it actually went up. And then it went down again. And I think what you'd see, and like in all this, it's a case study, n equals 1, right? So there's big caveats around how much conclusion we can pull out of this. But I think if you did this study across 100 different startups, you'd find that the old style, that it continued much, much longer. It had a longer tail, a fatter tail. And I think that's influence. I think that's ownership from an investor in what they're investing in. There's a personal connection with the founder. And there's influence that comes to you from your introductions and that propagates, and you turn around and influence somebody else. And I think when we behave like more efficient markets, we don't, right? So I thought that was the most interesting thing. Here's the efficiency again. This is what the time wasters look like. This is what the successful old style fundraising looks like. And that's important to tease out because you know if you're using an intermediary, you know you're using an AngelList, or you know you're in a demo day. You don't always know what this person is, whether it's one of those people or one of those people. Again, n equals 1, very, very small sample size. I don't want to overclaim anything here, but there was no initial introduction here that was more than 3 people. There was no initial introduction through this or AngelList that resulted in any money that was less than 10 people. Right? So all of the productive paths started with a huge amount of introductions. Again, small sample size, but I think this would continue to hold if you looked at it across 10, 15, 20, 30 startups. And this makes sense, right? You want people who have power and influence in the ecosystem, right? And that's reflected in how many connections they can make. And you also want people who believe in your startup and they've bought in and they have ownership. And if I have, so what you really want is, you want to know if Jim could make 20 introductions and he makes 2. Okay, never talk to Jim again. If Jim can make 20 introductions and he makes 18, that's important, right? And he believes in you, and he's made those intros with some force, right? I'm going to keep moving along a little bit fast. So this is what it looked like backed out. We talked about this to death. Any more quick questions before we move on, or we can also talk about it at the end? Please.
So how did you control for the fact that they could have 20 introductions but only make 10 or 18?
I don't know that. I didn't, and I don't know that.
So there might be other supernodes that are just not visible in the network because they didn't make these introductions.
Yeah. That's a piece that feels very hard to get that would be incredibly valuable. If you could know what the potential was. And you could overlay existing networks and get some kind of score.
You can just look at AngelList and who follows whom and put supernodes there and overlay that with your network. Because that gives you like a global network of a global ecosystem of investors and entrepreneurs.
Yeah. I think there's some potential there. I think it still comes with a lot of risk, even with AngelList. If you look at the initial syndicates that are running, it's very public people that have a lot of fans, not quiet investors that have great networks. They're sort of like fourth, fifth, sixth down the leaderboard.
Weight the network by the actual investments that they make, not just by the follow-up.
Yeah, but then you would weight Greylock much lower, or let's pick one that doesn't have a seed fund, you'd weight Excel much lower than 500 startups. But in reality, Excel has as much influence as 500 startups. You could argue more. I don't know.
Or you can go to Facebook and go to startup groups and see who are the influential people in these Facebook groups that are dedicated to specific startups.
Yeah.
Because the API is that there.
Yeah. You'd have some selection problems there because the ones that need that groups aren't the ones that have power. I'm not trying to challenge to cut you apart. All your ideas are very good. It's mostly to have a discussion about how hard it is to look at this space and how comfortable we have to be with ambiguity in the data and conclusions that are maybe not as strong as we feel. You know, like I think there's something here, but I have to caveat the shit out of it because it's so much less rigorous than is accepted, right? And I think this is what it takes right now in studying startups and the ecosystem to be really useful to the immediate actors, to go from blog post up a level, but not as high as, you know, PhD. Please?
Did they change something between the July and September?
Yeah,
Because
totally.
like
Yeah.
the second angel raise was much more efficient.
Yeah.
Much more efficient. Did they like change the pitch or did they?
Yeah, that's an awesome observation. That's a great observation. So yes, they changed the pitch, and every startup is changing their pitch continuously. Next session, we'll talk about that. His pitch was a disaster here. It's just a complete, utter disaster. And what you happen is it gets better, and it gets slightly better near the end, but decreasing returns, right? There's a couple things, very important things that happen here. One is the time of year, right? So we were going to do an analysis of how is your happiness through this process? Like how emotionally, how healthy were you, right, Daniel? And we didn't get to that because we didn't get to a lot of things. But he had a graph that was pretty high, super excited. And then in August, when all the investors are on vacation and nobody gives a shit about you, it drops. And this was the low point, right? And then he came back out. And what happens in September, and we sent his out on, I think, August 29th, but really activity kicks up, September 3rd, 4th, 5th, 6th, quite obviously, is that there's many more people taking pitches, there's many more people in the market. So part of it is the time of year. The same thing happens as dramatically about right now. So you would never start fundraising in November. In the US, you'd hit American Thanksgiving, and then you'd hit a lull while everybody's in Christmas parties, and then the 3 weeks before Christmas, there'd be nothing. And then January 3rd, 2nd or 3rd, whatever, it kicks back up pretty dramatically. And we saw this at Angelus. We just saw the activity drop off. And so there's definitely times of year where it's much easier to fundraise. The other thing which I think is more important and more substantial is that I think your startup is super different. It looks incredibly different before you raise money and after you raise some. So say you're raising $1 million. You have no money. You can't make payroll. You're essentially like a plane crashing, all right? You raise 100,000 of $1 million. It's a sign, it's a confidence. It's sort of a sign that other people have confidence in what you're doing. Finally, you can survive for 3 months, right? You raise $600,000, you raise $1 million, and all of a sudden you're a completely different company, and you look completely different company as somebody would invest in. This is like certain death. This is like, oh my God, you got a great future for 18 months. Right? And the difference is 0, 100K, 800K. It's hard to invest at this stage, and very few investors do it. I think, and again, like this is something, if you're interested, I'm challenging to do a bunch of thinking on this because we need a lot more, but I think there's a percentage of investors who are prepared to write the first check into a company, and that percentage is small, and my instinct is it's sort of like 15, 20%. Very few are going to do it. Most of them wait until other investors come on board and they say, oh, who's investing, blah, blah, blah. So that's what happened here, right? So he looked different when he had probably $150,000, $200,000 committed and these people to vouch for him and their reputations, and it made it much easier. So that's the other thing that played out.
You may not have done this research, so I'm just your opinion on this. Just from Reed's portfolio or something else, do you find that unicorns or something are coming where people have actually invested on the people when it's zero, on the zero mark? Because intuitively it feels like that's when you have to get in.
I don't know.
For the big returns. You know.
No, this is a super interesting area to think about, and I don't have an answer. Some of the research I've heard of, but not seen directly and dissected, indicates to me that hype of investing in a round is not correlated with outcomes. So what this means is that you have, and there's thousands of these types of companies being funded every year, right? And a bunch of them are able to raise $3 million, $5 million at the stage where Daniel could raise $1 million, or somebody else could only raise $500,000. And how quickly rounds closed and how much demand there was for a round. So hearing this from a smart person who's done it internally says that there's not, he's learned that there's not that much, if any, of a correlation there.
Between the, sorry, just repeat that, I wasn't following you. Correlation between the, you repeat that correlation?
Between the amount of hype or demand for a round.
Doing it there. Okay,
Yeah,
that
and the eventual outcome.
That makes intuitive sense. Right?
So what it means is that, so what it means is that there's a bunch of opportunities that are not 100% funded.
So I only had one, on that specific, on the zero, there's a guy, Syriac, who started Shopkick. He was sitting in, you probably know Syriac, he was sitting in Kleiner's offices, right, with a deck, right? And his basic proposition was, we're going I want to drive more traffic into retail stores, so I'm going to do that. And I was at Best Buy, and I started Best Buy Capital, and I was doing a bunch of things. So I took a team out there, and we were looking for new ideas. So we went to Kleiner's office, and the Kleiner partners, like, they always open their doors to us. They're like, basically, okay, look, there's Syriac sitting here. So we went to Syriac's little office next door, and we sat there, and he showed the deck. And he said, so what are you trying to solve? He says, well, you guys have problems with people going into the stores, so I'll solve that. Mobile app, German guy, blah, blah, blah. I know mobile more than Americans, etc. Nice pitch. But generally speaking, he was like really, only realized afterwards, he was very close to the edge, because the Kleiner guys were saying, if you don't get Best Buy to buy into this, you're at zero. Like if they don't do a test with you. Yeah. So we did warrants, we ended up, I just decided there and there. Yeah. We basically did it was zero. Like there was a deck, right? But luckily, I didn't give him a lot of cash. What we just said is, you can use our stores, try it, go. Warrants, and we'll introduce you to other CMOs. Every time we introduce to more other CMOs, we get more warrants. Like to Target and others in Minneapolis and others. So, and that's probably been the best, like that was good, right? That was the best. Another one was an electric bike, right? We went there, it was a prototype Bramo bike, you can check it out. I talked about it. Bramo, yeah. Now, Best Buy didn't eventually sell it, but it's selling in China like crazy now. It's like a sports bike, but it was all to do with that guy. It was all to that, and it was zero. That guy was like really on edge. Yeah. But I'm not saying that's gonna be, but it just feels that at those moments, and I don't know if like, it must be, and I'm sure Reed would say that, because there's a, I don't know how you quantify that, which is why you don't have the, maybe you'll have the metrics on like a quantitative way to do this eventually, but it's really hard.
We don't, and we think a little bit in sort of an entering little world, live in a world of people who are trying to use more data in our industry and stuff like that. And it's stuff that you can't quantify. Really it's point events. What are the odds that you would have walked in and provided that first
it's people,
validation?
Right? It's people. You take a bet. I know this is a cliche, but it's guts.
Yes.
Yeah. Anyway.
So I think so, but I don't disagree with that at all. I think it's very hard. I think the predictive abilities of our industry are probably there, very difficult to get to. Not 100%. Blah, blah, blah.
Angel List. A couple of weeks ago, I went in there and I was looking at this stuff because I'm trying to waste some money. And I looked at this stuff just to try and learn. Like, not too much. But I don't know where to go because it's like hype. It's completely hype based. Like, the people are promoting each other. Yeah. I don't know what the founders' eyes look like.
Yeah. I think there's a longer discussion that we should have after, but I think we start with that, and I think we get to more concrete things as this evolves. I think we get to more concrete metrics. Yeah.
Can I ask a question to this slope you drawn? So what is the motivation of only paying like $10,000 to a company? Because when you're one of the first ones to invest, you know that $10,000 will not help anything. And when you're confident that it's a good deal because other people have already invested in it, then why don't you buy a bigger share?
Yeah, or why don't you wait until the risk is lower because there's more money in? Like putting the first $10,000 of $1 million round into a company is at the same price that the last $10,000 would go in is stupid, but that's the way our industry works. I think it's irrational. So I think you have a bunch of irrationality from an investor that would do that. That is almost the only way. Like that's one of the pivotal pins of our system that works, is because there's crazy people that will put the first money in. I think we're moving a little bit more towards being more dynamically priced. And so even across one round, you'll have slightly different prices at the beginning, the middle, the end, maybe. In some cases, most still not. Or you'll give some discount at the beginning because it's clearly a different good that's being purchased. And frankly, those people deserve, I just think they deserve a better price. And so sometimes you give them a discount on the note, or sometimes you give them some advisory shares as a thank you or something like that. So I think we're going to see much more of that. And then the last thing that we're seeing on the crowdfunding side, so it's coming from the other side, is thresholds that have to be hit before that gets triggered, right? And so the risk is eliminated because of that, because if you're investing in a motorcycle company on Kickstarter, I don't know if there's been any, anyways, then you only invest if it gets to 1.5 million. Yeah, let's keep going through, and we can talk after. We'll blast through this. Fundraising is hard. It sounds trivial, but it helps to see how hard it is. So if you're doing it, you can feel a lot better about where you're at. It's also cyclical, so that was your question. Big differences in when you'd plan to raise. And because of this one, actually, because momentum is everything, if you start and get no traction in your fundraising in August or in mid-December, it might mean that you come out with nothing. Whereas, if you had a slightly better start in March, you'd actually come out with a really good result. It's nonlinear. It's very, very momentum driven. Disproportionate funds come from a few people, and disproportionately strong connections come from a few people. So the trick, and I don't think we've solved this. I certainly have not solved this 100%, but is identifying which of those are really high potential. So ranking your sort of connectors and your opportunities. I think that's very important. Most of these people are going to waste your time. I think that's inevitable. It's not like you're not going to pitch them, but find ways to systematize that follow-up and that management of all these relationships so that it's not a huge burden every day when you have to think about, okay, which 30 people haven't replied to me yet, and actually 28 of those are really low likelihood of success, right? New tools can help. We're going to talk about that a little bit. This is uncomfortable openness. AngelList push this. Demo days push this a lot. People are having to be more open about what their company is about, where they are earlier than they ever would be, like 5 years ago. For investors, this is pretty basic stuff. The market is becoming more efficient quickly. I don't think investors have totally internalized this yet. There's going to be an interesting shift in the order that's happening. Proprietary deal flow is declining. I'm not the only one to say that. I think passion is a differentiator, though. I think if you're in a market system and you're making one investment and there's other 9 investors that have made it, if you're the one that turns around and contacts that person that you may not have even talked to, if this goes to a completely stock exchange style world, to contact that person and say how can I help? I think your reputation is going to rise dramatically because the bar will be lower. Market intermediaries are rising. AngelList, I have a slide next. AngelList, Seeders, WeFunder, blah, blah, blah. Advisory, I think, is becoming more important than connective. So what you can offer in terms of very tangible advice is very good as an investor. And I think how this is playing out is people who have very specific backgrounds are finding companies to support that they can be helpful in very specific ways, right? So if you help scale the ops side of Twitter, you're going to find companies and they're going to want you that are in a position where you can really help. Growth is happening as well. People who are really good at growth are finding great investments because they can bring something very obvious to the table and not just I'm a big name investor, right? And reputation is going to brand. I don't think brand goes away yet. I don't know. A couple more slides. What's happened since then? This is accelerators. This is probably 1/100th of the number of them. They've continued to explode.
What do you think of them?
I think there's a...
What's the general quick story? What's the general... there's a lot of them, that's all.
I think there's a huge spectrum of quality, and at the high end, they're incredibly helpful. I think the low end, which I think is 90% of them, they're a waste. And they can be, I think they can be very helpful both in terms of the best ones that are horizontal, the Y Combinators, AngelPad I really, really like, 500 Startups I like, and a few others. I'm forgetting a few. Or you can be verticalized and good as well. So Rock Health is a good example. I mean, it's an easy choice to choose an accelerator like Rock Health if you're a health-oriented startup. And so I think that's going to provide value as well. But I think there's going to be, it's like an MBA, right? I think there's sub 30 programs that matter in the world, and I think you waste your money on the next 51 to 500. Yeah, and it's very hard to compare. Everybody goes through this experience once. I don't go to multiple MBA programs and say, oh, actually, Oxford was great, and this other one that was not so much. So very hard to compare. So I don't know what we get to. The only way I understand which accelerators are good are the ones that I work with and where I see the cohorts getting better time after time, right? I just look at the delta and the quality. And you can look at sort of proxies, downstream funding and stuff like that too. Cool, thanks. This is happening, we know. It's happened more and more. It's been unleashed a little bit by the Jobs Act in the States. I think there's more of this coming. I think the policy was behind what's actually happening on the ground. Not only that, not only can you invest as an AngelList, but you can essentially be a VC on AngelList now. So they're backing into the industry in very productized and efficient ways. It's pretty interesting. You have a bunch of investors. There's many more than this. And I don't know anything specific about a lot of these guys except for us that are thinking about how you work in an efficient market and trying to do that. And then you have a bunch of data happening. So this is App Store. This is collecting a bunch of different types of data and helping us understand it and combining it like this and this. This is a platform. This is an amazing provider of information. This is funding. These two are funding rounds. Anavo, unfortunately, was bought by Facebook, but an interesting insight into retention, engagement, and how engaged mobile users are. So this has exploded in the past year. I mean, when I joined Greylock, we were playing with a lot of this stuff, and then since it's just exploded. And then what you have is, I think, coming and much more than this, but higher granularity information and data about our industry in a way that's usable, right? So previously, this would have been in probably one of the law firms in Silicon Valley or New York or London, where they have information about what term sheets are. But this is really useful information. You can say, okay, I'm a Los Angeles startup with people that came out of PayPal and Yahoo, and went to Berkeley, and how much should my valuation be? Like, that's amazing information. That's never been. And yes, this is biased just to AngelList's group, and that's only a percentage of the whole world, the whole universe, but it's coming. And that's only a starting point in negotiation, but it's coming. There's much more coming. There's going to be deeper data and information on people and companies, on the investor side. There's going to be better matching and quality assessment early on for companies. And I actually am not somebody who believes that over a certain threshold, I ever want to make an investment in a company without meeting the person. I'm actually not saying that. Like, I do really want to have the conversation. I want to know how they think.
By the way, I'm completely old school. I have no clue how to. I'm like, so don't. I'm just. This is a personal.
But I think you made the point. I think it's right. I think
right. What you'll probably create and you'll create together will be what we'll all live on. It'll be quantitative, and you can just go, hey, that's a cool venture there. And it'll have a market, and people will get it. Maybe.
We might.
Maybe not.
I still like that piece. I think that's incredibly important. But I think we can be much more effective getting to the table, right?
But what you're saying is just astounding me. I don't know, maybe everybody here knows this. This is amazing information. Like, even 10 years ago, 10 years ago, it's nothing. It's like it's a little office, and Reed will have some information. This guy will have some information. I mean, this is like, it's opening up.
Yeah, and the crazy thing is that the world of investors moves very slowly. So when this is happening very quickly, as the feedback loop of normal investors is 10 years.
It's great insight that somebody like you is looking into this for some Greylock. Suddenly it's gone up in my estimation. Take money from Greylock or something.
I can speak convincingly. It's not.
No, I mean, but it's like, I don't know how many others are looking. I know Vantage Point wasn't.
There's
when I was a partner there, I would have our Monday meetings and we'll sit there. Have you seen the founder? Where is he?
We still do.
Sure. Oh yeah.
We
It's
still
this,
do.
you know. Oh yeah, man. Oh, who else is in?
Yeah, still.
I mean,
But I don't like, and I think I think that the level of deal you're talking about, and the level of deals we do, I mean, there's so much that maybe it can be quantified, but we're not anywhere near there. Where do you think the world is going? Like, what high level trends do you believe in that make this decision an amazing thing? Like, I haven't figured out how to model and quantify that, and frankly, like,
So do you
I don't
know
want-
Better Place? The whole thing, the failure on Better Place. You know Better Place, big investment, clean tech
Yeah.
investment, Shai Gassi. So Alan Saltzman at Vantage Point invested in it,
Yeah.
right? Big time.
Yeah.
Big. We're going to change the world. Clean tech. We're going to
Yeah.
charging stations. He's got Israel. He's got everything. I just joined after that, like 6 months, 7 months after, about a year after. I was at Best Buy when I joined.
Yeah.
Now, none of the partners agreed with him, right? And he tells a story, so this is not, I'm not giving you, but none of the partners agreed. And he sat there and all the quantitative, everybody there's some smart people in that room, they were just bringing it out. This is not gonna work, it's not gonna work.
Mm-hmm.
And he just took a bet. And that's what I liked about it. That's why I joined them actually, at that time.
Yeah.
Right? Because he took a bet.
It was the same.
Now,
Yeah.
you know, he took a bet on Tesla too, right? The first 40 and the second 40 million. The second kind of round, he took a bet on Elon. But, you know, probably didn't behave right after that and sort of get into the next round. No, I mean,
He was on
you know,
that.
Elon started to become a star. So in a sense, you don't start to control, like you don't put traditional VC type,
Yeah.
behavior on somebody like Elon, right? So Jurvetson didn't do that. So he got into
That's right.
3 or 4 rounds.
Well, he's just crazy about space.
But I don't know how you get that data here. I just it's good, but it's.
I totally
that-
agree.
it will
And
eventually.
from
It
what I
will.
understand it,
It will. It's got stuff.
Yeah.
People, who's investing in who and
Yeah. I mean, from what I understand about it, like Facebook was an unconventional bet for David Z to make
completely.
at that round.
And Jim, by the way,
And he felt very, very strongly about it, and that's why.
and Jim,
that's why I think
and you have to find the hungry people at the time, right?
Yeah.
So Jim was like, Excel was not doing well.
Mhm.
They couldn't raise the next round. Jim was smart. He's doing so. You gotta
Yeah.
find the hungry people.
Well, there is something in the decision-making, analytics of decision-making that I think is interesting that most don't do. And I think, I don't know, and I don't know this from any experience at Greylock, but I think it's where there are strongly held opinions, even if they're diverging. It's when you have everybody saying like, yeah, this is probably good enough, like those ones are not that interesting, right? They don't end up that good. So there's even some analytics that you can do on the human decision-making. We're gonna have this happen, I think, evidence-based reputation. And we already do, but there's so much of a lag in our industry that, Greylock had a great year last year. I had nothing to do with it, but we were in the 4 largest IPOs we were early stage investors in. We were in something like 6 of the largest 7 IPOs in 2012. Those decisions were made in 2006, 7, 8, 9. And so it's not that isn't evidence, but I think the feedback loops are going to become much, much tighter. And this is something that I really feel strongly about because this is like the Series A crunch. If you guys hear about that term, the Series A crunch, and how there's so many seed funded companies that are not making it to A, I think we're looking at it wrong. I think at the earliest stages we should be funding experiments, and the prices should reflect that. And we should be maybe not okay, but more okay if it doesn't make it. I feel like if you launch 1, 2, 3 experiments, convince investors to fund that at a very reasonable price, and you don't make it, I think that's okay. Like to see that's a company, and this is the company that's going to be 100 years old, and we're going to, 50-year company, and then it just has to pivot to this dramatically different area. Like to me, that's, we're funding experiments versus companies. Anyway, so that's what I have. I'm sorry we don't have a ton of time, but we stopped into it. But I just want to leave on this note that I think it's an incredibly interesting time to be thinking about early stage capital, and I think there's a bunch of entry points and disruption points that don't look like the large reputations of 1, 5, 10, 20 years ago. Cool, and we've got time for a couple questions.
Yeah, so for the official portion for the questions here, we've got maybe about 5-10 minutes here, and I'd like people to use a microphone so we can be included in the recorded session.
Yeah,
I'll
please.
bring it over to you.
Cool.
Yeah, thanks for your presentation. I was curious, you talked about maybe pushing people towards no. You obviously want to do that a little carefully, but maybe should the question not always be about funding and instead, are you interested in advising us in a certain way? Like I'm looking for this key advisors, and then they say, that's not what we don't advise on that, and then that's a no of sorts. Is that a way to get around that? And then the other question is about crowdfunding and stuff, are you excited to jump in after a crowd seed or a crowd A, or is that something you'd shy away from?
Couple good questions. So pushing to no. I think, so I don't have the benefit of a bunch of different funding ecosystems to speak from, only the one that I work in, which is Silicon Valley. And there people they don't beat around the bush, right? If they're raising money, they're raising money, and they don't try to couch it as something else. So there's always an explicit ask, and that's fine. It's not awkward. I think in some at the beginning when I wasn't as used to this context, it was awkward, and I would want to sort of like tiptoe my way there. I think one of the exceptions is early in your fundraising process when the pitch is not quite ready. It makes sense to speak with the first 20 to 30 people, maybe let's say 10 to 20 people, which are actually mostly going to be entrepreneurs that you need to convince, or other like sort of connectors, but some investors maybe. You frame that as advice, right? And you use that as a feedback mechanism for the pitch. I think we'll talk about that a little bit more in the next session if you have the benefit. Crowdfunding. Yeah, we just invested in a company called Smart Things that did a bunch of, I'm pretty excited about it. What's that?
I have Smart.
You have it?
Yeah.
Nice, how do you like it?
I haven't used it much. I was a little disappointed because I got it right when I moved here. So.
Okay.
And they don't operate in the UK, so it's like, so they said they're working.
That is unfortunate.
Yeah.
Well, I'll talk to Josh. I'll make it happen. I'll make sure they get into the UK. No, I don't have that power. That's cool. Yeah, we're really excited about that. But they had a huge amount of traction through crowdfunding, and I think home automation is a pretty tough space for to start from zero, and when you can show that kind of market response. So we don't. I think probably I don't speak for Greylock, but I think investors in general probably care less about the funding part and more about the customer validation of the early crowdfunding platforms, like the Indiegogo and the Kickstarters. So Ouya was funded out of that. Pebble was funded out of that. So you do see, when they don't want to try to raise $10 million from 100,000 people or whatever that's going to look like, they'll go to us or CRV in the case of Pebble or something like that.
I mean equity crowdfunding specifically as opposed to rewards crowdfunding.
I don't know how it's going to play out. I think how clean the cap table is going to be a big thing because it definitely affects. I mean, not 100% of our decision by any means, but it does play into decisions if the cap table is really weird. You're saying, well, what is the ownership and what does that mean about the actors in this situation? And so if the cap table is completely messed up, I think it's going to affect downstream funding. I think that the platforms are smart enough to know that they can't let that happen if they believe in a world that needs downstream funding, and I think most of them still do. So that would be the biggest place that I think it's going to play in. I don't know yet. That's a whole other talk of that sort of like the crowdfunding, what's going to happen. But cool. Next. Anybody else? Yeah, why don't we go to the corner?
So I was interested in the concept of using convertible notes to fund what you're calling experiment. And what are your company's view on that?
I don't know. That's a good question. I'm not somebody who's close enough to the term sheets to really think about this, and I'm not a founder, so I've never been through that process and had to decide equity versus convertible note. I haven't thought about it. What do you think? Do you think that would be a good format to use for this? If there was a higher likelihood of failure?
As a software developer with over 15 years of experience, I've seen a lot of things come and go, and we've had a lot of ideas, some that have seen the light of day and others that haven't.
Mm-hmm.
But I think without being able to experiment and look at a broader set of problems, you can sometimes miss out. So typically in a team of 8 people, you might have 4 or 5 experiments on the go that you'll bootstrap funding yourself.
Yep.
As a small company, but as a small company, speaking from experience, you're absorbing all of that risk.
Yep.
It would be a lot smarter as a small company to be able to go out and find a
Yeah.
Greylock and say, hey, would you fund some of our experiments? That's the question.
I think that's really interesting. I believe in it theoretically. I'm not sure if I believe in it practically. And here's the reason. And this is actually happening a lot more. There's so many more labs companies that are trying one thing, or moving up a level. There's a bunch of greenhouse companies which are different versions of Idea Lab, which was sort of legendary in the late 90s, for just launching companies out of them. So that is happening.
Your customers might do that.
Yeah.
Yeah, so there might be
Yeah.
whoever you're producing the software for,
Yeah.
right? So they either can't do it themselves, that's why they might want to acquire a startup at some point. So they may want to buy an option. That's what they'll be doing, right? They'll be buying an option saying this little hotshot team of 8 people might be able to experiment and sort some stuff out. And they might do that. So it depends who you're producing it for, which actually cuts out the VCs.
Historically speaking, I don't want to take over, but my customers have been universities, and they typically don't want the IP, and they're not interested in a loan kind of format. So you end up going for a grant, which is hard work.
Okay, interesting.
Yeah. I think the reason, it's an excellent question, and I hope we figure this out as an industry. The reason I say I believe in it theoretically, I'm not sure if I believe in it practically yet, is really structuring and being very detailed about the arrangement so that you understand when something spins out, how is it separated, who has ownership over that, where does that ownership end, who goes with it, who stays. Like, these are all things that when you're running, it's not so different than the greenhouses. You say, like, we have a common structure that we have shared services like legal, like marketing, like some development capacity, whatever, and we're launching all these different companies. It gets very nuanced and messy when those companies spin out, when you're dealing with humans, especially. And so the ones that have been successful have drawn fairly clear lines around what ownership is, both in the sort of contract sense and also in the sort of my own feeling sense. So I think it's possible, but it's very hard. I think it takes special situations to make that happen right now. It's pretty messy, but I want to see it happen.
On this side of the pond, it's very difficult to protect software. It seems to me that this model would suit Silicon Valley better because your game plan could be to try and protect these experiments.
I don't think we care. I mean, I don't know about the specific protections on software. That's not what I'm good at. But I don't think we care about. Now all of a sudden I represent all of Silicon Valley. I don't think we care about protection that much. I mean, you can't have a non-compete agreement. You can't, nobody signs NDAs. People just expect that a lot of the elements of software are now shared or are commodified. And so I'm not sure that we would care that much about it. Yeah, let's grab, there's one more question, and then I think we're probably over time. But we can chat after. Yeah, please.
Well, I wasn't necessarily going to ask a question. I was just going to comment on what we've been talking about.
Totally.
I was going to say that one of the biggest problems that I would see in a convertible structure, right? I mean, everybody's talking about IP and all this other kind of stuff, but what we're forgetting about is the actual structure of the deal, right? So, if we're looking at startups, right, Silicon Valley developers and stuff like that, there's a financier that I say, okay, well, if I structure a deal like this, are you going to be able to pay it, right? So if you can't pay it, you have no deal, right? So nobody's mentioned that, which is why a lot of times you have equity funding models in Silicon Valley, right? So, I finance large infrastructure projects. So that's a little bit different because, you have revenue that's thrown off by, this particular project, or we have underlying assets that may be minerals or, whatever it is that we can, that we have as like an underlying sort of asset to the overall project, right? So it's a little bit different in that way. If you don't have that with technology, it's going to be hard to structure and know. So
I think there's a context above the specific contracts that's important as well. Like we would need confidence that there's not going to be some adverse selection, that you're not going to keep the super high potential projects in-house when they're working, or you're going to save the best ideas for the 20% that you're funding in-house and stuff like that. So there's a trust and confidence and contextual layer above or below each specific situation. I think that's very important as well. And this is the same, we had the slide with AngelList and the syndicates and backers, and Naval is pretty explicit, like that he is pushing those investors to push all of their stuff through that platform because he doesn't want their backers to just get the shitty deals, right? And so I think this is, it's normal. That's interesting.